International Conference on Accounting and Finance.
Session Chair Professor Gunaratna, my dear colleagues, ladies and gentlemen, a very good afternoon to you all. My paper for today is titled An Analysis of the Determinants that Affect the Capital Structure of Firms. It is an empirical study of the firms listed on the Colombo Stock Exchange. Before getting down to the main contents of my paper, I would like to run you through my presentation. I will first speak to you and give you an introduction about what my background entails. I will look at the research questions, followed by the scope of the research and the limitations and the constraints I ran into during my course of study. I will also look at empirical literature, both international and local as well, the key literature. I will also speak to you about the contribution of my study to the existing body of knowledge. I'll speak on the research methodology and data collection aspects. I will also give you the sample pilot analysis and the results. And I will bring in some real-world scenarios of how my study has an impact on firms listed on the Colombo Stock Exchange. The capital market is where companies raise funds for their short-term and long-term objectives. Now, if you take Sri Lanka's capital market, in 2013, we raised over 100 billion rupees in Sri Lankan capital markets. Now, if I'm to equate into US dollars, it amounts to 800 million US dollars, which signifies the vibrancy of our capital markets. Now, the decision makers who decide on which type of financing to go ahead realizes that the financing decision has an impact on the value of the firm. The research questions which I will be asking is, what are the determinants that a firm takes into account when deciding whether to go for equity or debt? The second question I want to look at is, what are the compositions of existing and past capital structures of firms listed on the CSE? Because it is an empirical study. And finally, what I hope to identify is the optimal debt structure that will maximize the market value of a firm listed on the Colombo Stock Exchange. Now, when we look at the scope of my research, initially I covered the whole Colombo Stock Exchange. Now, I believe there will be a few more firms than 288. But what happened is I ran into some issues. The issue was that certain firms in the financial sector, investment trusts and closed-ended funds had a different business model which was affecting the leverage factor. Hence, I decided to exclude them and I refined the scope to 195 firms. The time period I'm looking at is 2004 to 2013. And the limitations happen to be that I cannot easily get data for all the companies before 2004. Now, if you look at the empirical literature and the framework which governs my study, Modigliani and Miller form the basis. They are the two people who came up with the theory of capital structure. Further on, Jensen and Mecklin in 1976 first started speaking about agency cost theory, where it goes on to say that the firm owners have access to information than the shareholders. In corporate finance, this is known as asymmetry of information, which means that when issuing equity, the shareholders are at a more of a disadvantage because they are not aware of what's actually going on. To back Jensen and Mecklin's study, in 1984, Myers and Majloff came up with three theories which form the root and fundamentals of my study. The three theories were the pecking order theory, agency cost theory, and static trade-off. Myers and Majloff in 1984 said that when a firm decides to issue either equity or debt, they send a signal to the market. They went on to say that a company prefers to raise finance through their own earnings first, because that does not send a signal. And they said that the companies do not prefer to issue debt. And they went on to say further that issuing equity was the last option they were looking at. Johans and Dhanraj in 2007 came up with a cost of further validated the weighted average cost of capital principle. However, this principle does not apply in certain companies in Sri Lanka, which I will show to you during the course of my study. I included a very controversial study by Harris and Raviv in 1991, who went on to say that the capital structure theories are inclusive. Perhaps my inclusion of this is detriment to my presentation, but I wanted to include it to show that I also looked at people who said that these theories are not applicable. Now, let's look at some local literature. If you take Samarkund in 1999, he looked at a few determinants of capital structures and leverage in a cross-section of firms. The emphasis being the term cross-section, which means that he has not covered the whole market. In 2010, Prahalatan looked at the manufacturing firms, leaving out the other sectors. Nimalathasan and Brabett in 2010 also looked at manufacturing firms. However, the significance of my study is that it will analyze the determinants of capital structure across all listed equities. And this study has not been carried out in Sri Lanka before. And there's an area of further study where I will try to find the optimum capital structure for specific industries. Because from industry to industry, the capital structure of firms will vary. Now, let's look at my research methodology. The data will be cross-sectional time series. Hence, pooled cross-sectional time series analysis will be conducted to avoid the problems of cross-sectional proxies. Because if we use cross-sectional proxies, there will be lots of inaccuracies in the data. This model was validated by Gull in 1999. Further, I'll be using Kahan's and Titman's model in 2007, where they came up with a model which analyzes variables that compose or that affect the capital structure of firms. I took their model and made a slight amendment to it, and I added 2 more variables. These are the variables that will be analyzed. I'm not going to delve too much into these terms, but I want to show you the 2 extra variables that I added, which are highlighted in red. Interest rates. For the interest rates, I'll be using the AWPLR. In banking terms, it's known as the average weighted prime lending rate, and the stock market index, all share price index. The rest of the variables can be seen in the slide, and I will not go to the extent of explaining everything. To summarize it, the variable I'll be looking at is on the left column, and the data identification means how I will be identifying that particular variable on the financial statements. In terms of data collection, I'll be using the Colombo Stock Exchange database where information is readily available. I'll be looking at the quarterly annual reports of listed firms. Announcements by the CSC will be followed. Central bank reports will be looked at. And statistical publications by the central bank will be looked at to get data such as AWPLR. The study is extremely comprehensive, and there will be more than 17,000 data points, which will ensure that the accuracy will be consistent. Now, when you look at my pilot analysis, I took 40 firms initially across 13 sectors. Now, if you look at the 13 sectors I've selected, the sectors that have been represented more than the others are the beverage, food and tobacco, diversified holdings, and manufacturing. The pilot analysis revealed some very, very important findings. Initially, the analysis revealed a mean gearing ratio of 0.39 to 0.44 across all 40 firms. Now, what does this mean? This basically means that if you look at a company, 39% to 44% of its capital structure is comprised of debt. However, saying that, there was a small anomaly. 3 companies, Ceylon Tobacco, Chevron Lubricants, and Nestle, averaged a debt ratio, DE ratio of 0.11. So I looked at this because it just did not match. This line further validates what Dr. Jim Mello spoke about at yesterday's presentation. Ownership of a firm has an impact on its composition. These 3 companies are owned by multinational firms, and their Sri Lankan branches are here. And I found out that if a firm is owned by a multinational firm, there's a good chance that they do not go for debt. They use equity funding as a result of the parental backing from their overseas branch. Another thing that came out through this is the preference to raise short-term debt. If you look at the balance sheets of all the companies, I've noticed that 0.21 is short-term debt, whereas 0.16 is long-term debt, which goes on to say that our companies in Sri Lanka prefer short-term debt. Now, the companies are at a disadvantage when there's a lot of volatility. Now, if you take Sri Lanka and the policy changes that took place, there's been quite a lot of volatility. So in a period of rising interest rates, the companies will have to be careful because their debt is short-term, and if you are having long-term debt, you might be able to lock in a lower rate for a longer period. Real-world examples of how my paper impacts real companies. Now, JKH is called John Keel's Holdings. Carson's Cumberbatch is a palm oil company. Now, these two companies are in the top 3 of the market capitalized companies in Sri Lanka. But they show contrasting results when you compare their market value and gearing ratio. Now, if you look at the little red boxes, you will notice that when the gearing ratio, which is on the x-axis, when the gearing ratio increases, the value of John Keel's holding comes down, which validates the concept by Dhanraj saying when the weighted average cost of capital of the company goes up, the firm value comes down. But look at Carson's, the blue dots. You will notice that despite the gearing ratio increasing, firm value is increasing too. Now, what is the reason for that? When I looked at it further, I came up with the second key important finding, that firms that are held by family members, closely held companies, issue debt without equity. Now, why would they issue debt despite the riskiness of the company increasing? The reason is that they don't want to dilute their shareholding. They will issue debt despite it increasing the riskiness of the company because they do not want to divest or dilute their shareholding. The second scenario is I want to show that despite these anomalies, the standard theories apply across the board, where you see the market capitalization of the firms decreasing as long as the gearing is rising. So despite certain theories holding, it's very important to note that there are anomalies in certain companies and that no theory is perfect and that all variables have to be consulted together before coming up with a finding. So I summed up 3 important conclusions of my study and also came up with an area to study further. The first finding is that the DE ratio across all industries, it is very surprising if you analyze across all industries, the DE ratio hovered between 0.39 to 0.44. Now, I will tie the first point and the last point and tell you the significance of this in a few minutes. The second point is that closely held firms may opt to issue debt despite its negative impact on gearing. The reason being is they do not want to dilute their ownership. The third point is short-term debt is the most preferred form of debt financing in Sri Lanka. It is conclusive. Now, the fourth point for areas of further study. Can lending institutions and investment banks take advantage of mean reverting to identify potential capital raising? Now, let me simplify that for you. I have said that the common DE ratio across industries is 0.39 to 0.44. If we identify a company where its DE ratio is less than its industry DE ratio, does that mean that the company could issue further debt? Well, Professor Gunaratna, I applied this model to my place of work because I work in investment banking, and we approached 4 companies who we identified who were undergeared, and 3 of them said that they were seriously considering looking at raising equity. The team was surprised how accurate we were with this model. So 75% success of using this model in real world scenarios. Now, how can lending institutions and investment banks benefit? My further study is based on this. I will be looking at gearing ratios for particular sectors, across all sectors, and come up with an industry-specific gearing ratio and use that ratio to see whether certain firms are undergeared or overgeared. So if a firm is undergeared, investment banks such as us could approach those firms and say, look, we believe that there's a possibility of you raising debt and still maintaining firm value. So I believe this figure, which I hope to derive in a few more months across the sectors, will be an extremely important figure for all stakeholders, including the listed firms, the lending institutions, and investment banks, as they will be properly able to identify potential firms that wish to raise capital either through debt or equity in the capital markets. Thank you.